And when I say syndications, a syndication is basically where a group of people come together to pool their money to go out and buy a bigger asset than they could have bought individually. That 108 unit apartment building that I invested into, I'm not rich enough to own all 108 units to buy it outright. But I can put my money together with other investors. Minimum investments are usually 50,000. So I can put $50,000 together between a bunch of investors and we go out and buy the building together. That doesn't only apply to real estate though. You can do that in private lending, which we're doing. You can do that in oil and gas, which we're doing. You can do that in, small businesses. Anything can be syndicated, meaning you raise investor money to go out and acquire it.
Welcome to Investing for Generational Wealth. I'm John Lai from Clive Capital. I'm joined today by my partner, Keshav Kolur, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flows, and tax benefits. Together with investors, we're investing in over 1,000 multifamily apartments under renovations, over 500 single-family rental homes under development, more than 350,000 square foot of industrial real estate, 700,000 of private loans, and we're expanding into other asset classes such as oil and gas, and helping customers and investors just like you create diversified, balanced portfolios. Before we begin, a quick disclaimer. As always, we're not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So do perform your due diligence before making any financial decisions. And of course, consult your CPA, your attorney, and others before making any investments. Again, I'm your host, John Lai, and welcome to today's episode. There's a better way to invest than buy residential real estate. And I'm joined with my friend and business partner, Keshav Kolur. Keshav, welcome back to the pod.
Yeah, thanks so much for having me on, John.
Yep.
It's that time of the month again.
Yes. Good time of the month.
Good time.
Keshav, we have a jam-packed hour today where we'll discuss how individuals invest in residential real estate today and what and why investors should be considering syndications, and then resources that they can take advantage of. So without further ado, Keshav, I know you were a licensed real estate agent at one point in your life where you were bullish on residential real estate. For those who don't really know about your journey, could you elaborate on your background and how you got to where you are today?
Yeah, sure thing. Thanks, John. And always great to be back on the podcast. We're also celebrating a year, coming up on a year. I don't know if you've mentioned this other episodes, but it's the 1 year birthday, 1 year of our Dear Baby podcast, Investing for Generational Wealth. So thanks to you, those of you who are listening from home. And here's to many more birthdays for the podcast. So my start, because it's relevant to today's episode, not to be a broken record here, but I started out, as a software engineer at a car company in Detroit out of college. And I read Rich Dad, Poor Dad, because I knew I didn't want to work for someone else for the rest of my life until I was 60, 65, be at the risk of layoffs, or just 2% salary increases every year, not even keeping up with inflation, or more recently, being replaced by AI. I knew I wanted to get ahead of all of this. So I read Rich Dad, Poor Dad in 2019 when I graduated college. And that book got me thinking about at least building a residential real estate portfolio. I don't know if it should have gotten me thinking about buying apartment buildings, which is what we invest into now, but it got me started somewhere. And, that was good. So at the time, I didn't know much about residential real estate investing, though, and I also didn't have much cash. So in the interest of killing two birds with one stone, I became a realtor, licensed realtor, got licensed on February 29th, leap day of 2020. And the goal was to build up additional cash in addition to what I was saving for my W-2, but also gain experience so that I could start residential real estate investing and eventually build my own portfolio of, 40, 50, 80, 100 homes that were paying me passively every single month. Because that's what I thought the best way was. Luckily, before I went too far down that rabbit hole, though, one of my good friends from college, he sent me a Reddit thread. Yes, you heard that correctly. Reddit thread. Not from Wall Street Bets, though, from the real estate investing thread, I believe, about a tech executive who was buying up apartment buildings because at his peak, he had owned 40 single family homes. And he said in that Reddit post that buying apartment buildings and investing into them is more profitable. One, two, has more tax benefits. Three, is more scalable. It's a lot easier to do and can even be passive or active, either one. And lastly, to me personally, it sounded a lot cooler to say I was investing into apartment buildings than just single family homes. But at the time, like probably most of you listening to this podcast, I didn't know anyone who was doing this. I thought it was too good to be true because if it was this good, why isn't everyone else doing it? So I spent a year researching this strategy. It's called syndications, investing into syndications, which is what we do now at Clive. And it took a year to analyze investments, network in the industry, read books, watch YouTube tutorials. And 1 year later, from when I found out in September of 2020, in August of 2021, I felt comfortable enough to make my first investment into 108 apartment buildings. Not buildings, sorry, apartment units in one building in Texas. Started seeing the cash flow coming in and the tax benefits. And from there, I knew that, hey, this is what I'm going to do instead of buying one home at a time or even a duplex or triplex, whatever it is. I'm going to play the big game. And I thought if I'm going to do this for myself, I want to do it for my family and friends and others who are interested. So fast forward to today, we're in all those different asset classes that John mentioned across 9 or 10 different states in the country. And, invested into over hundreds of millions of dollars of assets. So right now we're going to go a little bit into residential real estate and what investing into that looks like. So some of the main strategies that are involved in investing into residential real estate that most people are familiar with are buy and hold, right? If you just buy a turnkey property, you could also here, you could do the BRRRR method, buy, rehab, rent, refinance, repeat. But, those are both, you're just holding for the long term. There's house flipping, right? Short-term profits, you get in, you renovate, 6 months later, you've sold it to someone else. That's not like the first strategy, the buy and hold, or that's a long-term play for passive income. And the third primary strategy that we see is short-term rentals. Airbnbs and things like that, your guest stays for maybe anywhere between a few days to a few weeks, and you get to charge a premium for it. And so coming from the tech space, myself and Meta and John and Amazon and a lot of our other investors who are primarily in the stock market, when they think about investing into real estate, this is what they think about. These primary strategies: buy and hold, flipping, and short-term rentals. Now, it makes sense why people might think that this is a good strategy. And it's definitely a good way to diversify outside the stock market because one, you're investing into a tangible asset, right? You can actually look at this property, it holds some intrinsic value to it, and you can actually go and see it. Whereas stocks, it's intangible. It's just paper, really. And second, there's leverage here. You can typically put down, anywhere between a 5 to 20% down payment and control 100% of the property value. So if you want to buy real estate that's worth $500,000, or let's say $1 million for easy numbers, you can put as little as 5% down. That's $50,000, right? Depending on your credit score and everything else like that. But you can't do that in the stock market as easily to that extent. That's two, leverage, pretty important. Inflation protection, rents generally tend to rise with inflation. So it's always a good hedge against inflation. Not all stocks do well against inflation. There's tax benefits. In the stock market, you only get, capital gains and like qualified dividends, I believe. I don't even know all that much because frankly, I know enough to know it's not a great place to be. In my opinion, the stock market's one level above a casino, barely, but that's just my personal opinion. In real estate, though, you have depreciation benefits where your taxable income can go untaxed because of depreciation. And that's one of the tax benefits that comes along with investing in real estate. And a quick 30-second primer on depreciation is basically the government allows you to say, hey, I bought a $500,000 home. This home over time will naturally lose value unless I constantly renovate it. And so that's an expense that the government recognizes. And the government wants to encourage investment into real estate because if we don't have a roof over our head, nothing else really matters besides food and water. I'd say those are the only two things that are before a roof over our head and power. So the government lets you say, hey, if I invest into a $500,000 building every year, maybe I'll take a tax benefit of $20,000, something like that. So any income that you get, it goes tax deferred or tax free until about $20,000 because of depreciation. I'm not a CPA, I'm not an accountant, and this is by no means in-depth explanation of depreciation, but that's at a high level how to think about it. And so residential real estate is a great way to start because it at least gets you in the mindset of thinking about investments outside of the stock market, but it is by no means necessary. You don't need to start at a single family residence. I never bought a single family home, a rental home, a personal home. I went straight into investing into apartment buildings. And now I'm in oil and gas, I'm in private debt, and a bunch of other investments as well. And the reason for that is while the benefits of real estate are great, residential real estate, those same benefits apply to commercial real estate and to syndications in general too. And when I say syndications, a syndication is basically where a group of people come together to pool their money to go out and buy a bigger asset than they could have bought individually. So that 108 unit apartment building that I invested into, I'm not rich enough to own all 108 units to buy it outright, but I can put my money together with other investors. Minimum investments are usually $50,000. So I can put $50,000 together between a bunch of investors and we go out and buy the building together. That doesn't only apply to real estate though. You can do that in private lending, which we're doing. You can do that in oil and gas, which we're doing. You can do that in, small businesses. Anything can be syndicated, meaning you raise investor money to go out and acquire it. So going back to why I chose the syndication route, the risks and challenges with single family, one, I mentioned it's not as profitable as commercial real estate or as syndications because you do not get to benefit from economies of scale. So in residential real estate, when you buy materials, when you buy labor, contractors, when you get insurance quotes, when you get loan terms, when you hire property management companies to manage your property, because you're only one house, they're going to charge you a lot higher than if you were to give them the business of a 100-unit apartment building. It's like shopping at Costco. When you buy in bulk, you get discounts. And so as investors, it's very beneficial for us to get discounts. Who does not love a good discount, right? So that's one of the reasons why residential real estate is less profitable and why we like syndications a lot more. Number two is market downturns, right? If you're like a broader market, but even more so a specific submarket, if you're investing only in the Bay Area, if you're only investing in New York or New Jersey, or you're only investing in Seattle, which is where a lot of our investors are from, because a lot of our investors primarily in the tech space, if any of these cities were someday in the future to lose their glamour and their status, there goes your entire portfolio. And you might think that wouldn't happen, but just a few decades ago, Detroit was the number 2 most populous city in the country, if my memory serves me correctly. Now we all look at Detroit and what are they known for? Frankly, it's not great water, high crime, and things like that. And even though it's coming back, that's just an example of how a city that was once really great at the height of the, automobile economy, now it has to fight its way back up the ladder. And we also saw what happened to San Francisco and how downtown hollowed out during COVID. So that is one risk with residential real estate that we don't face with syndications because it's a lot easier for us to diversify, as we'll talk about later on in the presentation. Vacancy issues is another one. If you own a single family home and the person in there leaves, they lose their job, they can't pay the rent anymore, whatever it is, you are immediately in the red because that's your only tenant. You're zero for one. Now, if we own a 100-unit apartment building and someone leaves, one person leaves, we're still 99 for 100. We can still keep the lights on. So our risk there is a lot less than investing in a single family home and that's one of the reasons. That's a lot of the big things that I'll say around residential real estate for buy and holds, at least. As far as the returns, the neighborhoods, and also like management is another headache that I will mention. So if you own a single family home, you have two options: either manage it yourself or hire a third party management company to do it for you. If you manage it yourself and you have a W-2, this is going to be adding another job to your plate. You have to deal with broken toilets, tenant complaints. If they don't pay their rent on time, you might have to go to court. You have to deal with all these issues. If something happens on the property, they might sue you too, because you're the owner of the property. On the other hand, and the other thing is, if you were to hire a property management company, sure, it's passive now, but you have to pay them. Typically, what we're seeing is 8 to 10% of the property's revenue. So that doesn't leave a lot of room for your return. On the other hand, in syndications, for property management fees, we only pay 2 to 3% of revenue. Because we're operating at such a scale, that 2 to 3% of millions of dollars is still a sizable chunk of cash for these companies to manage our properties. Second is that, if someone were to sue, we carry a lot of insurance at our properties, and it makes a lot more sense to do so because we operate at such a big scale. And two, your downside as an investor is only limited to what you invest in the property as a passive investor. Whereas if you're managing your own single family rental, they can come after you for everything. That's my understanding of it. Again, not a lawyer. These are just some of the things that we took into account when John and I were evaluating single families. Now that brings us to short-term rentals, right? One of the big things here is that the returns are very volatile. If it's peak season, then your short-term rentals are doing great. But if it's not peak season, then you're not doing so hot and you're bleeding. I personally sleep a lot better knowing there's something consistent coming in every month rather than, it being a boom and a bust cycle. The other reason that people want to be doing short-term rentals is for the tax benefits. You get to reduce your W-2 taxable income. For that, we have our oil and gas investments, where every $100,000 invested, you get to reduce your W-2 income, your capital gains income, active income, passive income, any type of income by $85,000. So $100,000 invested, you reduce your AGI, adjusted gross income, by $85,000. Depending on your tax situation, that amounts to a tax savings of about $20,000 to $30,000, maybe $35,000. And that's passive and it's scalable. We've invested into 8 wells in North Dakota. We've invested into another 8 oil and gas wells in Wyoming as well. And we're passive. You don't see John nor I with the hard hat on out there actually drilling for oil and gas. I'm sitting in here in New York. John sitting in Portland.
Portland.
Yeah. I was going to say Seattle. Very close. Okay. The other thing with short-term rentals is the regulatory hurdles. There's over 220 cities, last time we checked, that either have restrictions or outright bans on short-term rentals. And there's the operational burden that you have with managing residential real estate as you would in a buy and hold. And the market is just a lot more volatile than I personally would like, at least. Lastly, that brings us to fix and flips. Here, this is probably the worst strategy of them all in residential. Obviously, there are people out there who make it work, and there's money to be made in a million different ways. But if you want to make money for sure, and passively, it's probably your worst way to make money because you have unpredictable costs in fix and flips. You have unpredictable timings. You have unreliable returns, right? You're just hoping and praying that someone's going to pay more for this property than you are, but you don't necessarily know that that's true. And unless it's your bread and butter day in and day out, you likely aren't an expert in fix and flips. And also there's tax inefficiency, right? You're taxed at short-term capital gains, which is your ordinary income rates. So you're going to lose 20 to 35% of your profits to the government. Why would you go through all that effort and all that risk just to lose a fifth to a third of your effort, a third to a fifth of your effort to the government? It doesn't make sense. So those are some of the strategies that we see, residential real estate investors take on and why it doesn't make sense. If anyone disagrees with us, like feel free to email me, text me. I'm here for this discussion all day long. But that's how John and I approached this when we were initially at the beginning of our journey, looking at how we should invest and build our portfolios, and why we chose the syndication route, and why our investors, many high earning W-2, employees in tech, medicine, consulting, etc., why they're choosing to go the syndication route. Frankly, in my opinion, the smarter route, the easier route, and the more profitable route. So with that, I'm going to pass it off to John. If you want to talk about just an introduction to syndications, what they are, how they work.
And syndications aren't very difficult. By the way, if you have any questions, drop your questions in the Q&A section. I see there's one question already. Keshav, do you want to answer that as I prep this next section?
Yeah. So we had a question come in about, should you factor into your investing strategy considerations into the consequences of investing into projects that worsen the climate crisis on the risk level of the rest of your portfolio and quality of life? Oil and gas doesn't sound like what you should be promoting actively nowadays. We recorded an educational webinar on oil and gas on our YouTube channel and our podcast. So definitely go check that out. This was back in December of 2024. And we mentioned that over 6,000 daily products, from makeup to shoelaces to even solar panel, wind turbines, the components for renewable energy require the byproducts of oil and gas. And we're not going to be replacing passenger vehicles anytime soon, the hundreds of millions of them that are on the road right now. Here in the US and globally, we can't just flip a switch and all just buy EVs everywhere. Everyone can't afford that either, right? It might be a first world luxury, but in places where, the economy is not as great as the US, they have to use the oil and gas, internal combustion engine cars. So you'll see that demand's constantly growing for oil and gas. And the transition is happening to renewable energy, but the renewables are taking a share out of what previously used to be powered by coal, I believe. Oil and gas is still not touched at all. So we need oil and gas for at least a few decades here as we ramp up to renewable energy. We're seeing that there are power outages across, Texas, across Europe. And a lot of countries in Europe are now going back to some form of oil and gas because the renewables just aren't there yet in meeting our energy demand. So, and the other thing to say here is we're presenting a few of our investment options and the things that we invest into. We're not saying that everyone has to invest into these things. So we invest into apartment buildings, we invest into warehouses, we invest into single family rental home construction, we invest into private lending, and we invest into oil and gas. And oil and gas might not be everyone's cup of tea, but there are still 4 other investment opportunities and options that John and I invest into and that our investors invest into as well.
So thanks for that, Keshav. What I'm going to go over really quickly is a simple model of how to understand syndications. Now, syndications are used everywhere. So they're not just used in real estate, they're used in oil and gas, they're used in debts, they're used in, frankly, anything that you can think of. Think of this as a model for that, a paradigm for that. So first of all, obviously there's an investment. You need to find out about investments. And then next, beyond the investment, whether you find it directly from the syndicator or the sponsor, you might have heard of that word before, or the operator, or you find it from a fund manager like Clive Capital, you will learn about the opportunity. And then what any of us, whether it's an operator or fund manager, will do is we'll provide you with the information necessary to do your due diligence, understand the investment. After you've understood and evaluated the investment, and decided to go forward. You want to learn more about it. You want to invest. And there's a term called soft commit. Basically, it's reserving your space to indicate that you're interested in this particular investment. And from there, soft commit, by the way, is called soft because there's no money that's exchanged in this. It's just to reserve your spot. After that, the time to actually commit the funds happen, and then you'll sign any of the documents. There are a bunch of documents that you probably will hear of: offering memorandum, PPM, there's deal disclosure. There's a number of these that you'll probably hear about. They're essentially all the documents that you need to understand the investment, the fine details around the investment, and then actually sign to commit your interest, as well as deliver the actual funds in order to invest. Most of the investment that you'll hear in private equity, at least through us, and then through other fund of fund managers and operators as well, is about 50,000. That's the minimum. There are some exceptions that we can talk about in the future webinar, but it's 50,000, and then any other commitment after that. So you might commit 50,000 and you might be interested in committing 1,000 or 10,000 more after that. You can certainly do that, but the minimum is typically 50. And then after you deliver that, we'll deliver it to the syndicator or the syndication, which they use all the monies to run their operations. So typically syndications will raise anywhere from 65 to 75% of their actual investment in debts, and then they'll have to raise and come up with the rest of the money in equity. And so that's where we come in. That's where other individual investors come in to invest in the operations. And then they'll take all that money and run their daily operations. Typically, depending on the syndication and the investment, it could be anywhere from a year to 6 years long, where they run the operations, after which they'll sell the asset. There's some cases they won't sell the asset, but real estate, typically they'll sell the asset and then they'll use the funds to send back to the individual investor or the fund of fund manager, and then we'll disperse those to our investors. That's the typical flow. Now, it doesn't get that much more difficult than that. So let me talk about what funds can be used. So first of all, the funds that can be used are obviously cash. If you have cash around and you have 50,000, then that's the most obvious way to invest into a syndication. If you don't have 50,000 lying around, you might have 50,000 in retirement accounts. So IRAs and either traditional or Roth, and then 401ks, whether they're the traditional 401k and they can be Roth as well, or solo 401k. Those instruments all can be used to invest in a syndication. Now, the caveat here is traditional retirement accounts cannot be used. If you have a retirement account with Fidelity or T. Rowe Price or Schwab, they can't be used to invest in these type of investments. It has to be with a third-party custodian, what's I call a self-directed custodian. If you've heard of self-directed IRAs, if you've heard of self-directed 401ks, those are what they are. They're third parties, they're not affiliated with us, but they will allow you to directly invest in these syndications, whether they're real estate, oil and gas. Frankly, they could be crypto, gold, they could be art, anything that you would want to invest in. There are some limitations, but more or less anything, it opens up the entire world to you. So definitely do investigate that. The third avenue for investing in a syndication is you might be able to use leverage. So for example, for my home, I took out a HELOC, and I took the HELOC, and when I opened it, it was a pretty low rate. It was like prime plus a percent or something like that. So right now it's about 7%, 7.5%, but I used that and that leverage, and then I invested something at a much higher return. So the returns I'm getting through this private debt deal, and then debt in general through us, it can range between 16 and 20%. In this case, I got about 20%. I was able to lock in about 20%, a little bit more initially. So if you think about the spread between the 20 and the 7, that's 13% I can pocket, right? So you can use leverage to your advantage, whether it's a HELOC, you might have equities in stock that you can take, not necessarily margin. Margin is a separate thing, but you can get a private loan from both equities and other type of instruments that you can then use to invest in these private equity deals. So that is how you can use leverage. And then the process is pretty straightforward. I spoke about it a little bit in the previous diagram. It's essentially you have to learn about the opportunity, right? And that's what we're doing today. Prior to learning about this 5 years ago, I was fully invested in the equity market. I didn't know about other opportunities except for hearing about it in the news, BlackRock and others, Bain Capital, the private equity arms that have billions of dollars to invest in companies. Well, that's one way to do it. But as a private individual retail investor, you can't invest in those. And you can't participate in the 20 to 50% upside that those have. So it was really learning about these opportunities that I started to learn you can invest in private equity, and you can invest it through real estate. You can invest it through oil and gas, private debt, even investing in private companies is something that we're investigating as well. So you learn about it, then you vet the deal, you do your due diligence, you indicate your soft commit, you're interested, you express your interest, you review all the documents, you sign them, you send over the funds, and then you're done. All you have to do as an investor is you really just sit back and then you collect the passive income as indicated by the PBM, as indicated by the offering memorandum, if there's is a passive income. And our deals typically have a passive income component and then also have a capital appreciation component depending on the investment. So do your due diligence, but you just sit back as an investor. So there's less to be done after you've done the investment. So that's great. So with that, let me talk a little bit about syndications versus residential real estate. So you'll see on this chart here, we've taken a look at various dimensions: cash flow, equity, leverage, tax, and so forth. So what you'll see, and I won't go through each individual dimension in each individual asset class, but you'll see that residential certainly checks most of the check boxes. Yeah, tax, there's some, but as it compares to cost segregation, accelerated depreciation of some of these other asset classes, it pales in comparison. But you'll see it checks most of them, but some of these other asset classes do a better job, right? Like if you look at commercial real estate, it does a better job of being tax advantaged, right? Oil and gas is a fantastic, as Keshav mentioned earlier, fantastic way to offset your W-2 income, right? And active passive income. So a lot of these asset classes do a much, much better job of doing certain things. So as you think about how you want to craft your portfolio beyond equities, being able to diversify into other asset classes, and then think about how and when you need that cash for retirement, or do you need passive income now? Think about how you want to integrate some of these asset classes into your overall portfolio so that you can get the diversification, you can get some of the passive income, as well as the tax advantages that traditional equities can't afford you. Okay. So I'm moving on to the next slide, which talks about projections. Now, these are just projections. You have to do your due diligence, looking at the private placement memorandums and ensuring that you understand what the actual projection of the investment you're looking at. But these are guidelines. So we looked at different asset classes. We've been segmented out residential real estate into potentially what you could look at. And the dimensions we keyed in on are IRR, internal rate of return, deductions, because we are all about saving money for our investors as well as ourselves, and then cash flow, because if you have to work to 5 to 10 years for anything to cash flow, it doesn't make sense. The other component is risk, because we want to make sure that we want to moderate the risk, mitigate anything that might happen, right? Whether there's a downturn in the economy, recession, we want to make sure that we mitigate that risk. So if you look at these dimensions across the board, what you'll find is that commercial real estate and then also private debt and oil and gas, they have the highest return to risk profile. So if you look at the return and the deductions against the risks that you're taking on, it probably has the highest return to risk profile. Oil and gas has decent return risk profile as well, because it has such high returns and deductions available to you, and the cash flow mostly across all of the other investment profiles. It has high return to risk profile as well. Whereas rental real estate and long-term real estate have a lower return to risk profile because frankly, they're a little bit higher risk. And the reason why we categorize the high risk is what Keshav mentioned before. In case there's some downturn in the economy, if you have one rental property, whether it's short-term or long-term, then if you lose that one renter, then you're 100% out of your income, right? You might have 2 or 3 renters in your place. If you lose one of them, that cuts it down by 33% or 25%. Whatever it might be, it definitely reduces your income flow For short-term rentals in particular, if there's a downturn in the economy, people may be cutting back on their spending, and you might see a drop in that income as well. Fix and flip, certainly, I think it's really high deductions, also relatively decent returns. It's just very risky, right? And that's something that we try not to touch. So that's the asset class summary. From here on, I'm going to hand it over back to syndications as a whole, commercial real estate, and then oil and gas, as well as debt and other type of syndications, and then residential real estate.
Yeah, sure thing. Thanks, John. So before we go, further into the discussion about why we like syndications over real estate, at this point, you might be wondering, hey, if you guys think syndications are so great, why have we not heard about this before? Why aren't more people doing this? And there's a few reasons for that, primarily being legal. Up until about 1982, these syndicators, these opportunities were only limited to raising $5 million from investors. Back then, $5 million is a lot, compared to what it is now. Maybe it's like $20 million in today's money, but there was a limitation nevertheless. After 1982, a new act got passed, the 506B Reg D exemption, I believe. Again, not a lawyer, but that law allowed people, now syndicators, fund managers, to raise an unlimited amount of capital from investors. So that ceiling is removed now, but you still couldn't advertise. So unless you knew someone who was doing this already, it was really difficult for you to learn about it because no one was allowed to publicly talk about this. Then come 2013 with the Jobs Act, the 506C exemption came along, and that finally 12 years ago allowed folks, fund managers, syndicators, to publicly advertise their opportunities and raise an unlimited amount of capital. And that's why this industry has gained a lot of steam in the last few years as more and more people start to learn about this concept. It's probably why your parents, your uncle, your aunts, or your grandfather or grandmothers, why they didn't hear about it, because you couldn't advertise it until 2013, only 12 years ago. The other things I will say is the lack of liquidity. These investments are not like the stock market in that you have to hold on to these investments anywhere between 1 to 6 years, depending on the investment opportunity. Not a lot of people can afford, unfortunately, to lock up $50,000, $100,000 away and never look at it, never touch it for that time frame, for 1 to 5 years. Especially when you consider that 70% of America, the wealthiest country in the world, even here, 70% of people live paycheck to paycheck, unfortunately. So for those who are in the fortunate enough situation to be able to vet these opportunities, to evaluate them, you're in a small crowd. And lastly, as with a lot of things in life, it's just a lack of knowledge and a lack of financial education. Everyone talks about all the time how our schools don't teach us about finances and budgets and, profit and loss statements, balance sheets, net worth, things like that. And they instead teach us things like history and literature, all that great stuff. That's another reason why this knowledge isn't more widespread, but hopefully as time goes on, more and more content like this is pushed out, more people will get access to these types of opportunities. With that being said, going back to you just kind of bring home why we like syndications more than we do residential real estate. One big thing here is the tax benefits. It's the depreciation, the cost segregation that you can take that allows you to reduce your taxable income from these investments. So you make great returns, but also the taxes you pay on them are less. Again, not a tax professional, but this is just how depreciation works. It's obviously going to vary based on your individual situation, but depreciation is just not something you're going to get in the stock market. Oil and gas, the depreciation benefits in that sector are real estate depreciation benefits on steroids, frankly, because the oil and gas depreciation benefits you can take against your W-2 income. You can't do that in the stock market. You can't even do that in real estate. Third, which is something John and I recently have begun exploring, is leveraged charitable deductions. I wouldn't say this is the syndication strategy, but it's just an investment strategy that's outside of the stock market and outside of residential real estate, where you basically are able to invest, quote unquote, invest or donate $1 to a charity, And you in turn get a $5 to $10 charitable deduction. We're evaluating a couple of firms that have been doing this for years successfully with their clients. But again, this is a benefit that you won't get in the stock market or even in residential real estate. This has the opportunity to reduce your AGI, not just your passive income, but also your taxable W-2 income, capital gains, etc. And it's more environmentally friendly than oil and gas. So folks probably are more in favor of it. Hard to say no to charity. And lastly, as John mentioned, self-directed investment accounts, retirement accounts, SDIRAs. Again, typically you have a 401k, a Roth IRA that restricts you to Fidelity, restricts you to Vanguard, and public ETFs that are only averaging 10% over the last 20 years. If you don't believe me, you can look it up. Stock market only does 10% on average. But some of our opportunities and other private syndications, private investment opportunities out there regularly hit above 15 to 20%. So from a tax benefit, we like syndications for some of those reasons. Now, from a risk perspective, when you look at stocks, you cannot evaluate most of us are not Warren Buffett. You might be able to evaluate some business models, looking at Amazon or looking at Coca-Cola, for example, or Apple. You might be able to say, hey, here's why I like this business. Here's why the business makes sense. Here's their profit and loss statement. Here's where it's going. But for most people, one, that's a lot of work. And two, these billion-dollar companies are very complex to analyze. And some of them are so much more difficult to analyze that even, Warren Buffett won't touch them. For example, Facebook, their revenue model is, or Meta, I should say, is very difficult to analyze as far as how do you predict ad revenue and things like that. You might have analysts on Wall Street who think they can predict it, but very few people can beat index funds. On the other hand, when we're looking at our private syndication opportunities, if it's an apartment building, for example, it is very easy to read the financials. It really simplifies down to, hey, here's the rental income that I'm making from people paying me rent. Here are the expenses that I have to pay every month, like utilities, insurance, property taxes, my employees and repairs. It's a lot easier to understand financials because it's a simpler business model, frankly. So when we talk about these investments, it's a lot easier to mitigate your risk too. In real estate, the easiest way to mitigate risk is say, hey, if the market's charging $1,900, will my deal still work if I'm only going to charge $1,850? If I can charge $1,850 and the market's charging $1,900, then that's a way that I can mitigate risk and be conservative. In oil and gas investing, for example, our returns depend on what the price of oil and gas is. So one pretty easy way we can be conservative is by saying, hey, I'm going to be conservative. And even though oil has averaged, for example, it's averaged $72 over the last 5 years, I can be conservative and say, hey, for the next 5 years, I'm going to assume it's only going to average $70 still. You might say the $2 difference is not much, but the reason that's conservative is because that $72 average over the last 5 years accounts for COVID, when oil prices went to a record multi-decade low. Another reason is oil matches inflation. It rises with inflation. So over the last 5 years, it might have averaged $72 a barrel. We've seen how much inflation has occurred over the last 5 years. So over the next 5 years, given we get to benefit from all that inflation as investors, the oil prices should be higher than $70 a barrel on average, but we'll still be conservative and model it only at $70 a barrel. These are things that you can't really model for risk in the stock market. All we can do really is just say, I'm going to sit there and accept 10% returns on average. That's it. Because that's all we can do. We don't have control over any of these billion-dollar companies. We don't get to peep into their financials, and there's a lot less transparency as an investor. Whereas with these private deals, these private syndications, because they are smaller, you have a greater deal of visibility into them. With that, the other thing that I'll mention is just diversification. John, if you could pull up our portfolio and where we are currently invested into in the US, you'll see that the 1,000 apartments that John mentioned under renovation, the 500 single family rental homes under development, the 350,000 square feet of industrial real estate, the 16 oil and gas wells. These are all very well diversified across the country. So about 900 of the apartments are in Houston, Texas. We are diversifying into Virginia and into South Carolina. Oil and gas is diversified into North Dakota and Colorado. I've never even been to North Dakota, but we've invested in there. We have built to rent homes that we're building in Louisiana and Alabama. And we have industrial real estate that we have bought in Ohio, Michigan, and Indiana. Never been to Ohio, never been to Indiana. But because I know our partners who live in these areas or they have connections in these areas, we're able to get into these deals that are very lucrative. For example, the apartment building that we bought in Houston with investors and partners about 18 months ago, we are achieving our returns because of tax exemptions. Not because of rental revenue, but because we're able to get a reduction in our taxes by partnering with the government and keeping rents low. Those kinds of special deals, special credits, special programs you won't get in residential real estate. And we're buying real estate at discounts. We're buying, oil and gas wells, deals that other people don't have access to. This is the power of investing into syndications, of investing with bigger groups who have more experience and are doing bigger deals.
Hey, Keshav, what do you say to investors who say, I only want to invest in an opportunity that is in my backyard that I can go visit? What do you say to that? And then compare that to where our investors are coming from.
Yeah, it's a good point, John. So purple represents our assets here. And the other asset that I'll mention is private debt, our private lending fund that we're investing into. That fund is lending in over 46 states in the country. Again, not something you could do if you're in residential real estate in, for lack of a better word, the little leagues, I guess. Not to say that in a punitive, condescending sense, but on like when you look at the deals, they are little, they are smaller. So that's the purple. The blue is where our investors are coming from. You'll see that a lot of them are coming from the tri-state area, the Northeast. That's where I'm based out of in New York City. And a lot of them are coming from the West Coast. They're coming from California. They're coming from Oregon. They're coming from Washington. Given our tech background, a lot of our investors are in tech too. They're at Meta, they're at Amazon, Google, Microsoft. You name these top tech companies, we have investors there. And they live in these areas that are great because that's where all the jobs are, that's where all the opportunity is, the best schools. But at the same time, that also means the cost of living and the home prices are the highest there. We hosted an investor meetup, our very first one, so we're really excited about how it went. This past Saturday in Fremont, and the median home price in Fremont is $1.5 million. If you were to try to buy a residential home there, you were to put a 20% down payment, you have to come up with $300,000 to put into one property. Talk about all of your eggs in one basket, right? On the other hand, in syndications, that $300,000, assuming your investment minimum into these opportunities in oil and gas and apartment buildings is $50,000, you can split that down payment that you've put into a home across 6 different investments. Instead of putting all of your eggs into one basket in Fremont, you could have put it into North Dakota, into Ohio, Virginia, South Carolina, Texas, and Alabama, for example. Diversified, not only geographically, but across asset classes. And so that's why a lot of our investors come to us, is because the real estate near them is very costly. And oftentimes they're investing in tenant-friendly states. For example, during COVID, a lot of tenants didn't pay rent, and it was really hard to take them to court because they were in states like California and New York and Seattle, Washington, I should say, that favored tenants, not the landlords, us as the investors. So with that, at a high level, the big reasons to summarize that we like syndications: risk versus reward. In our mind, syndications win. Lower risk, higher reward. Time commitment. Syndications are passive compared to investing into your own residential properties, and the returns are better. So if you're making more money and spending less time, why would you not choose that option every day of the week? Third is frankly, also personal goals. I will say investing into syndications isn't for everyone. If you are not able to trust other people with your funds, which is ironic because you trust Wall Street with your money anyway. At the end of the day, you're putting your money with someone, and it's out of your control. If you can't trust someone, or you feel like you have to have 100% control over your investments and you cannot relinquish control, to managing an apartment building to a professional group, then syndications aren't for you. But if you're fine collaborating, trusting other people, trusting the right people, of course, there are the wrong people to trust, but trusting the right people, and you're willing to get a little educated about how syndications work, then you will achieve the outsized returns, the lower risk, the tax benefits, the passive income, all of that good stuff. So with the remaining 5 minutes that we have, great question came in about if we were to invest into a syndicate today, what should be the first step? So the first step is to get educated. And this is actually what we're going to go into next. So great question from the audience. Education is first. You have to read books, as I mentioned. You have to, consume content, learn how to analyze deals, and also network with the right people. So just by attending this, webinar session, you're doing the right thing. You're getting educated. I would recommend going to our website, clivecap.com, and we'll include a link to it, but there's an ebook on there where we discuss the ins and outs, the 101 of investing into syndications. Again, we'll include a link in the description, but check out our website, clivecap.com. And all these educational resources are free. We also include a due diligence checklist, 100 or so questions they should be asking any syndicate, any fund manager you're investing with. Yeah, including us, can ask us these questions too. And also it's networking, reaching out to people like myself, like John. There's plenty of folks on LinkedIn too that you can reach out to. There's books on syndications. You can read The Hands-Off Investor, for example, by Bigger Pockets. That's a good book on syndications. And get practice analyzing investment opportunities. If you go to our website, again, Clive, or if you just Google Clive Capital or myself or John, you'll see our investor portal. Sign up there, again, for free. You can just practice analyzing the investment opportunities that we have. And that will get you accustomed to what to look for in investment opportunities, where are the risks, how do I mitigate risks, how do I know what the right team is to invest with. So those are some of the initial steps. Yeah.
Yeah. And I would say feel free to schedule some time with us too, because we can help you understand based on your needs, what type of investments make sense. If it's passive income, there's a certain type. If it's tax deductions, there's certain types and so forth.
Another question came in, great question. Can you talk a little bit more about exiting syndications? Each syndication is different. There are hundreds, if not maybe even thousands of syndication opportunities out there right now. Every single one of them is structured differently. You will want to check the legal documents for each syndication regarding how can you exit them. Most syndications, it's difficult to exit until you sell. That can be anywhere between 1 to 5 years, but you will know that up front when you're presented with the syndication opportunity. And some syndications allow this. Not all of them do, but some syndications, if you find someone else to buy your shares from you in the syndication, you can basically swap with them and they can take your place in the syndication. And you can get you can exit early that way. But otherwise, it's a matter of waiting for the syndication group, the sponsor group, the partnership to sell the asset. And at that point, you can exit.
That's why it also is important to know your buy box, not just IRR, equity multiples and so forth, but how long you intend to be invested in any particular investment. If it's something that you need, monies you need within a year, you have to take that into consideration and just look at those syndications that have that time horizon.
So we're going to stop sharing screen here as we wrap up, but some ending, final thoughts before we end the show for today. We talked about why syndications are better than residential real estate. I firmly believe this. Unless it was to buy a personal home, I would never invest into residential real estate. Or if it was for personal reasons, you wanted a vacation property somewhere, then it makes sense. But investment wise, your dollars go much further in syndications. As far as next steps, as we mentioned, feel free to reach out to either myself or John on our website, clivecap.com. Also, subscribe to our podcast, Investing for Generational Wealth. We post episodes, including this one, every week on, I believe, what's today? Wednesdays, to YouTube. We post the video to YouTube and the audio to all the major podcasting platforms, Spotify, iHeartRadio, Amazon Music, Apple Music, all the spots. So go there, give us a shout, give us a listen, subscribe. We definitely appreciate it. And that's it for today's episode. So thanks everyone for tuning in to today's episode of Investing for Generational Wealth. And we'll see you here next week.